Hello, everyone, and welcome to the latest edition of LPL Market Signals. Jeff Bookbinder here, your host for this week with my friend and colleague, Lawrence Gillum. How are you today, Lawrence?
Oh, I'm doing good, Jeff. But it's starting to get cooler here in the Carolinas. It's starting to feel like fall, so it's the best time of the year, in my opinion, anyway.
Yes, well, you need it cooler more than we need it cooler, maybe up here in Boston, but it's, pleasant 60 degrees and it's not raining for a change. So we'll take that. So it is Monday, October 9th, 2023, as we're recording this. It's a bit of a somber day given what happened over the weekend in Israel. So we will talk a little bit about that up front and then get into the regular scheduled program. Let's start with the disclosures and then the agenda. After we comment on the war in Israel, we'll talk about stocks following the bond market's lead last week. It's really all about rates. Actually, the theme for this whole podcast is rates. Look at the jobs report from Friday. Interesting market reaction that, it certainly looked like it was too strong up front, but then the market reconsidered. So maybe it wasn't too strong. Glad we have Lawrence here with being a fixed income guru. He'll tell us where rates might be going. That's an easy question. Easy prediction, right, Lawrence? And then last, we'll preview the week ahead, which is other than the focus on what's going on in the Middle East, we will look at earnings season quickly and talk CPI. So before we get into the recap, just want to comment on the events over the weekend. We've certainly been asked, by folks what might be the potential market impact. I mean, of course, you start with the tragic human cost. It's always uncomfortable to talk about market impact or economic impact at times like these, but that's our job. So that's what we do. First you look at the oil market, right? That's where this conflict is more likely to be, transmitted into economic weakness. Oil's up 4 or 5%. The energy sector similarly. And that can, of course, have impact on economic growth and consumer spending. However, unless Iran is brought into the conflict, the impact on the energy markets might not be very large. You might see this knee-jerk reaction, and then those gains could be short-lived. So certainly it looks like, based on how markets are trading today on Monday, that Iranian involvement is not the base case. So if the conflict remains contained to Israel and Gaza, you might not have much economic impact. You might not even have much energy impact. So that's one piece of this. The other piece is we'll look back in history. When war breaks out or when you have terrorist attacks, and this is really both, you tend to see the stock market shrug it off. If you look back to even World War II, on average, stocks are a little bit higher a month after these events, 3 months after these events. And really, it's the economic cycle that determines whether stocks fall. So given where we are in this cycle, we think stocks are more likely to be higher in a month or 3 months based on history and based on the fact that this economy continues to hold up quite well. So, we wouldn't be sellers tactically on this event. And certainly, we are overweight energy and we like that positioning a little bit more today. So anything to add to that, Lawrence, from the bond market perspective? I mean, it probably takes the risk of a Fed hike down a bit, right?
Yeah, certainly. I mean, it definitely depends on how long this war skirmish it lasts. And to your point about Iran is spot on. If it spreads and Iran becomes a bigger participant in this event, certainly that'll have more lasting impact, we think. But as it stands now, well, the U.S. bond market is closed today for the holiday. But if you look at the rates markets for non-U.S. developed markets like the U.K., France, Germany, bond yields are all lower, as you'd expect them to be, given kind of that risk-off sentiment in the bond market. Given the fact that there could be a bigger argument for a skip for the November meeting for the Fed, given kind of the geopolitical events that are taking place. So by and large, it's not. It doesn't have a tremendous impact on the fixed income market. It certainly won't have a big impact or a lasting impact if this is short lived. Certainly, the inflationary story is going to be the bigger driver of where bond yields are going. But for today, anyway, it does look like the risk off environment in the non-U.S. developed market is taking place.
Yeah, and you'll see a little bit of support for precious metals too. Defense companies are certainly seeing a lift. That makes perfect sense. You'll probably see Congress come together at some point. Given the current dysfunction, we don't know when, but you'll see Congress come together at some point and fund Israel defense as well as more Ukraine funding as well. So let's transition. There's no good transition out of that to the market recap for last week. You see here, not only were stocks resilient last week, they're resilient so far today, up 0.5% last week, up similarly today, at least as we're recording this. And that whole gain really came on Friday with the reaction to the jobs report. At first, people saw, 300,000 plus jobs and immediately sold, or at least the machines did, on the thought that was, hawkish for the Fed. But then when you look one level down, you see that the wage numbers in the jobs report for September were actually pretty calm, actually better than expected. And then the market kind of changed its mind and reversed solidly higher. So that was really the whole story for last week and why we ended up. And you saw like a risk on kind of a tilt with the NASDAQ outperforming, tech doing very well, up about 3%. The tech-heavy comm services sector also did very well, up 3%. That's where Alphabet and Meta are. And then on the other side of the coin, ironically, you had energy. The worst performer last week is oil collapsed on inventory fears. So, we'll get back some of those losses today, of course, but energy a laggard as oil gave back some of those big gains as markets started to focus more on just traditional supply demand in the US and less on geopolitics. At least that was Friday. Obviously, that's flipped in the other direction today. And we really didn't see, we saw, the gains in the US, but really didn't see gains overseas at all. You can see losses in Europe and pretty much Asia across the board. A little bit of a gain in India, a little bit of a gain in China. Strong dollar certainly continues to weigh on international equities, though for now we do have a slight positive bias toward international equities and remain neutral, the U.S. So Lawrence, how about fixed income last week? I mean, the job market was maybe a little bit healthier than people thought, and that put some pressure on bonds.
Yeah, so stop me if you've heard this recently, but bond yields were higher last week, 6th week in a row. In fact, the bond yields have been higher. We've moved about 0.7% on the 10-year Treasury yield over that 6-week time period. So it's been an unrelenting move higher in Treasury yields on the back of stronger than expected growth, which we'll talk about in just a second, as well as just a glut of issuance coming to market over the next couple of quarters in terms of new Treasury securities that the Treasury is going to issue to fund deficit spending. But in the meantime, it's really, frankly, no place to hide across fixed income sectors. Yields were higher, spreads were a little wider in the corporate credit markets as well. So it seems like it's kind of getting close to the end of this backup in rates, but we've thought that before. Given the kind of the unrelenting move, we think that there's going to be a breather eventually, and maybe some consolidation. But until that happens, momentum has kind of pushed yields higher and continues to push yields higher. Now, as we talked about just a second ago, the bond market is closed today, so maybe there's a little reprieve due to the situation in the Middle East, but it's been tough sledding over the past 6 weeks, in particular for fixed income markets.
Yeah, it sure has. I looked this morning, and the odds of a rate hike in November are like mid-teens, very low. And I think the odds of a December hike have come down as well. So this does increase the odds that the Fed is done, but obviously we can't declare that with a high level of conviction just yet. I also want to point out, it was a tough week for metals last week. I mean, it's been a tough month for metals, but certainly for those who are concerned about a wider conflict in the Middle East, precious metals certainly makes a lot of sense. And frankly, that geopolitical tail set the weak or the strong dollar if we continue to get dollar strength. Remember, strong dollar usually means weakness in precious metals, but there are other drivers to precious metals that can overtake that. So I want to point that out too. So S&P was, well, it's up today, but it was, well off of its highs over the last several weeks. And now we got to the point on Friday at the lows, we were right at the 200-day moving average pretty much, and very close to this 4,200 level of technical significance. So we would argue from a technical perspective, that was a successful test and is a good thing, is bullish. Maybe that's part of why stocks are up today and part of why they were up so nicely Friday after those early morning losses, because the machines like the technical setup. So obviously the question, as I have here on this slide now, is, are we going to get a fourth quarter rally? We talked about that last week. On average, you get about a 4% gain. So certainly based on where we sit now, that's possible. But it really, we think, is going to be dependent on rates, to some extent, certainly on the Middle East, but really rates is the key. And so with that segue, here's rates. So technically, Lawrence, I know you've talked to Adam Turnquist about the 10-year yield chart, and he tells me 4.9 is the next resistance, and then 5. So do you think we have are we at risk of breaking above 5?
Yeah, I mean, we're really close to it now, and given the momentum of higher yields that we've seen over the past several weeks and months, I mean, it's certainly possible. If you also think about the Fed funds rate and the yield curve just in general for the U.S. Treasury securities, a lot of those securities are already above 5%. We hit 5% on the 30-year last week as well. So 5% is doable for sure, which I'm still in awe of the economy's ability to handle 5% Treasury yields. But so far so good in terms of the economy continuing to grow and digest these higher yields. But 5% is certainly doable for sure.
Yeah, I'll take a good economy with high rates over a bad economy with low rates any day. So there's the glass half full take on that. But yeah, there's really not a ton of resistance if you get up above 5. We'll keep watching this, but maybe you taught me this, Lawrence. Maybe the best thing about higher rates is that they attract buyers of bonds because bonds look better.
Yep, and I think what's interesting is that there's very little resistance there because it's been such a long time since we've had yields in this range, right? So I mean, we went a whole decade without yields above, or the Fed funds rate above 0, right? So we're in a new regime. We think we're in this higher for longer regime, which we'll talk about in just a second. But because of that absence of higher yields over the past decade, once we break some of these overhead resistance levels, there's not a lot of technical support for anytime soon, which could keep pushing yields higher.
Yeah, I've heard talk of the bond vigilantes, right? Pushing yields higher to force fiscal discipline on the federal government, and that's going to happen eventually. Who knows when? But the U.S. debt is much more expensive to service as you get at higher interest rate levels. I know you wrote about that recently, Lawrence. The economy. I mean, we don't know when the economy is going to start to slow. We haven't really seen a lot of evidence that it's starting to happen yet. But when it does, it's going to be hard for yields to keep moving higher. So that's probably the point where bonds start to look really good, even though we think they look pretty good right now. Last chart before we get into the next segment here, I wanted to show this correlation chart and make the point that the relationship between stocks and bonds changes depending on the levels of inflation. Okay, I know there's a lot going on in this chart, but it's a very simple concept. We have high inflation now, so stocks and yields move in opposite directions. Okay, if we had low inflation, stocks and yields would move probably in the same direction, right? You want more growth when you're in a low inflation environment. You want more growth, you want yields higher. We don't want yields to reflect more growth and more inflation anymore, right? We used to want that. Now we don't. And so that means that for now, and probably in the near term, we need yields to go down for stocks to go up, right? Stocks are really kind of following the bond market's lead, as I said in an earlier slide. So the good news here is that we do think yields are eventually going to head down, and that's going to be good for stocks. And then you can take that a step further and say, the market eventually won't care as much about yields or as much about movement in interest rates because inflation's coming down. And maybe we won't get to the Fed's target for another, 18 months or something. But once we get down there, and we think we will, then we can get past this obsession with interest rates and the Fed. And that'll certainly be a good thing for stocks. So I thought that was a very interesting point to make. We're still, as stock investors, we're still kind of, prisoners of the bond market. So let's go through the jobs report real fast. So, north of 300,000 jobs, way more than consensus, which was around 160, depending on your source, basically double that. We also had upward revisions to the prior 2 months. So it was like, it was like doing 450 to 500,000 when you factor in the revisions. Now, the market looked at the composition of the job gains and saw, strength in leisure and hospitality jobs, strength in education jobs, government jobs. Generally speaking, lower wage jobs made up the bulk of the new jobs that were created in September. So that's how you get this blowout job creation, as you see here, and this little uptick in the 6-month moving average in the orange line, to a better story on the wages front, right? It's a mix shift. So we had a decline in the year-over-year average hourly earnings change, or wages, right? It was a little better than expected on a month-over-month, 0.2% rather than 0.3. And then your year-over-year was, continued to come down, right? You see that in the orange line. So 4.3%. So this continues to be a good story. I mean, it's slow to come down, but it continues to be a good story for the economy and for the Fed as wage pressures abate, even though we have strong job market. So anything to add to that, Lawrence?
Yeah, I think
did
one of the things
the bond market interpret this correctly?
Yep. So one of the things I think that the bond market looked at and said that maybe this wasn't as impressive as the headline numbers would suggest. If you look at things like the number of workers with multiple jobs that started climbing again, indicating that there's some part-time work out there that's increasing, particularly as that excess savings start to dissipate. Number of self-employed increased as well, looking again for additional sources of income. So that headline number was obviously extremely impressive, but maybe there are some reasons why that there's a lot of jobs being added. And then if you look at the household survey, which is separate from the survey that we're looking at on the previous screen, there's two job surveys that are released on Jobs Day. There's an employment survey, and then there's an establishment survey, and then there's a household survey. The household survey wasn't as robust. So that one looks at individual households and say, has your employment picture changed at all? And that partially gives credence to that multiple part-time job story, because it wasn't as impressive as that establishment survey at the 336,000 jobs. So I think the bond market initially saw it as like, wow, the Fed has to do more. But then when you look under the hood a little bit, it wasn't as robust as maybe the initial headline number would suggest.
Yeah, good point. And then in survey data, we've seen businesses planning to hire less, right? So there's a number of indications like that that suggest that the job market is cooling. You just don't see it in that 350 number that we saw last Friday. So thanks for that, Lawrence. So here we're kind of putting you on the spot. I mean, I sort of asked you this already. But where do rates go? And I know you changed our forecast for year end, and we don't have a 2024 forecast, but generally speaking, based on where you see the world today, where do you think yields maybe head between now and year end, and then early 2024?
Yeah, it's hard to believe that 2023 is coming to an end. We're in the process of updating our 2024 outlook piece. We got to start working on that, Jeff, here shortly. But this end of year target has changed coming into, we'll call it the mid-year outlook piece. We thought the 10-year Treasury yield would end the year between 325 and 375. That was on a slowing economy, a less hawkish Fed. Maybe the Fed took the Fed funds rate to 4.5%. At 5.5%, the Fed has moved through that 4.5% target that we're kind of looking at. So we did update our forecast for the end of the year for this year, which will certainly bleed into 2024 as well. This year we think rates are kind of where they're at right now. So 425 to 475 is our target. We're at 4.8% right now. We do think that as the economy continues to digest these higher rates, there's some potential speed bumps in the way of a robust economy. The interest expenses are going to go up for companies and consumers. We got higher levels of prices and higher rates for things like auto loans and mortgages and credit cards. So we do think maybe the economy slows towards the end of this year, so it should take some pressure off of the 10-year Treasury yield. So we think that the big move in yields has already happened. But that said, the economy continues to surprise to the upside. That's the chart we're looking at here. This is the Bloomberg Economic Surprise Index. Since May, the economy has continued to outperform economic expectations, and that has pushed yields higher alongside those positive surprises. So the bond market had been pricing in a slowdown, an economic contraction. If you go to the next slide, the bond market was pricing in recession, right? That's what happens, or has generally happened when the U.S. Treasury yield curve inverts. You get this situation where the bond market starts to expect rate cuts due to a slowing economy that ends up inverting a yield curve. And right now, the bond market is pricing out those rate cuts. In fact, so we're starting to see that disinversion. We've come a long way in terms of that disinversion. 2-year Treasury yields out-yielded the 10-year Treasury yield by about 1% early in, I want to call it July. We're about at 0.25% now. So the inversion or the disinversion has moved a lot, but as long as that disinversion is still negative there, as long as the U.S. Treasury yield curve is inverted, there's the risks that intermediate and longer term yields can still go higher. So 425 to 475 is our target, with risks that maybe we see 5% this year or potentially early next year.
So I know, Lawrence, everybody focuses on the initial inversion of the yield curve as a recession signal, right? Very popular recession signal. But the lag is really long, right? In some cases, it takes a couple of years. I mean, if you lengthen your recession call long enough, you're going to be right every time, because eventually we have a recession, no matter when it is. So my question is, how about the signal of disinversion or sort of normalizing? I mean, obviously that gets you closer to recession. Does that potentially increase the chances that over the next 2-3 quarters that the economy slides into recession, or no?
Yes and no, and this is where it may get a little wonky. So I apologize, but there's 2 ways that a inverted yield curve can disinvert. You can either have the 2-year Treasury yield fall in anticipation of Fed rate cuts, or you can have the 10-year Treasury yield rise in anticipation of a higher for longer Fed, so pricing out rate cuts. So the first one is called a bull steepener. We have our own language in fixed income world. The first one is called bull steepener, which means the front end of the yield curve goes down. That's positive for bonds. That means that the bond market is pricing in Fed rate cuts. And that has typically been a very good sign that recession is close, right? The market starts to price in rate cuts because the economy is slowing. The Fed usually cuts rates to help stimulate the economy, et cetera. What we're seeing now is called a bear steepener. These are much more rare. And what we're seeing now is the long end of the yield curve kind of catch up to the front end of the yield curve. So the back end is selling off as these rate cuts that were expected by the market get priced out. So this is generally, at least initially, not a great signal in terms of recession. That said, as these longer term yields go higher, the cost to borrow increases as well, which could paradoxically, as the bond market's pricing out these recession risks, could actually increase the risk. So it's kind of like I said, it's kind of wonky, but the more reliable signal, or the more straightforward signal, I would say, is when the 2-year Treasury yield starts to fall. This one, it doesn't have a great track record, but it does, you could argue, increase recessionary risk because the cost to borrow increases pretty significantly.
Yeah, great points. And you, I think, are seeing the at least some of the Fed speakers today acknowledging that the bond market's doing some of the work for them, right? Higher interest rates mean market-based interest rates, like the 10-year, mean maybe the Fed doesn't have to do as much in terms of hiking the Fed funds rate. So, we would have more conviction that the Fed has done now than we had probably a few weeks ago. And then you add to the equation higher oil prices if we do get that, and that adds even a little bit more pressure to the economy. So, we still think that if we have recession, it'll be very mild and short-lived. But the odds that we do get one over the next few quarters have risen, no doubt. So good discussion there, Lawrence. I mean, I can't believe it. I'm an equity strategist, and I actually followed everything you said there, shockingly. But I really think I did. Quiz later, right? Quiz later.
That's right.
So let's go into the preview of the week ahead. I mean, as I mentioned up front, I mean, it's going to be all eyes on the Middle East. That is a potential tinderbox, to put it mildly. So that will, with regard to the energy markets and frankly the economy, if it spreads, will be the main focus, I think, for folks in the days ahead. But beyond that, we have CPI this week, and we have the start of third quarter earnings season. This earnings season is going to be really interesting because you have a strong economy, you have some inflation still, and wage pressures are coming down, or generally cost pressures are coming down. So, and revisions are good, right? Estimates have actually held up really well. So all that would line up normally for a really good earnings season, right? Relative to expectations. However, the dollar has essentially been a straight line up since companies provided guidance last quarter, right? So that's going to limit how much upside we can get. So, instead of maybe 4 or 5 points being the base case, we would say maybe 2 or 3 points of upside should be the base case, because the dollar is that big of a headwind for international earnings, right? About 40% of S&P 500 profits come from outside the U.S. and other currencies, and then if the dollar's strong, that eats into those foreign source profits. So it's going to be tough for the market to grow, the S&P 500 at least, to grow earnings more than, let's call it, 3 or 4 points. But we think with consensus right now to up a half a point, which means the end of the earnings recession, we think a +2, +3 is a very reasonable expectation. Now, the next question is that enough to move the market? Given everything that's going on, maybe not. It'll be enough probably to move the energy market. Like energy companies, we think are just going to have a blowout quarter. And that remains our favorite sector. We still like industrials as well. So we think with energy and energy tied investments, we think are going to do very, very well because, for most of the quarter, oil was rising. And we've seen positive revisions in energy stocks. That looks like a really good place for upside surprises. But beyond that, it's just going to be a little bit tricky with that international drag. So we'll see. Hopefully it is a positive catalyst and helps us get to that Q4 rally. Maybe just getting us focused on something other than yields will be positive. But we don't think we're going to be in a situation where, companies blow out the numbers and forward estimates go up again. If they hold up, that's a win. So, and by the way, Q4 estimates are probably too high. Plus 9% Q4, that might be a little bit of a stretch. So, turning to the economic calendar, I think it's all about CPI. We had energy prices go down during September, so that should be good, but now obviously they're reversing higher now, so we'll see about what happens in the next couple of months. But this is still a good story. Year-over-year CPI looking for 3.6%, core ex food and energy 4.1. We're getting very close to having a 3 handle on core CPI, and we're right around there on the core PCE, the Fed's preferred inflation measure. We have been saying pretty much all year we thought we can get to the mid threes. It looks like we're still on track for that. So I think CPI is going to be the highlight. Anything else here, Lawrence, that you would highlight that might be interesting? Maybe the
Well,
Fed minutes?
interesting for the bond market anyway is just all the Fed speakers. You referenced a couple of them
Sure.
today. There's a ton of them out there this week. I think I counted 12 or 13 different speaking engagements for Fed officials. And then, of course, the Fed FOMC meeting minutes will be released, I believe, on Wednesday. That could be interesting given the hawkish pause that we saw last meeting and kind of the discussions around their interest rate projections. So for the bond market, it's certainly CPI, but also the Fed speak that we're hearing today and likely to hear throughout the rest of this week as well.
Very good. I think given the barrage of economic data last week, we could use a break. We'll get through the CPI, and then things will be quiet, at least based on the economic calendar anyway. So with that, thank you all for joining another edition of LPL Market Signals. Lawrence, thanks for being here. I really needed you this week because it was pretty much bonds and rates all day long. And as you know, I cannot do a call on bonds and rates by myself. So I appreciate you. I guess with that, we'll go ahead and sign off. Thank you for joining, everyone, and take care. Have a good week.